Leadership is more than just a title. It can be the deciding factor between an era of prosperity and a period of economic hardship. And when it comes to economic policy, decisions made by central bank leaders have lasting impacts. Take, for example, Andrew Mellon, the Treasury Secretary during the 1920s, whose decisions during the Great Depression era serve as a powerful reminder that policy choices aren't just background noise, they're the driving force behind economic outcomes. Today, we're witnessing a pivotal moment in economic leadership, and it's one that could define the trajectory of the U.S. economy for years to come. Few days ago, President Donald Trump announced his nomination of Kevin Worsh to replace Jerome Powell as the next Federal Reserve Chair, provided Worsh is confirmed. The market's response was swift and telling. Gold saw a dramatic drop of over 14%, Bitcoin fell by around 4%, and the Nasdaq slipped by more than 1%. A sharp shift in gold prices, in particular, doesn't happen without a deeper story unfolding behind the scenes. In this video, we'll unpack three key topics: who Kevin Worsh is and why his potential appointment matters to investors, Worsh's stance on monetary policy and its implications, the broader market impact, particularly on assets like gold and high valuation stocks. So let's dive in and explore these points in detail. Who is Kevin Worsh? A deep dive. Kevin Worsh is no newcomer to the world of finance and central banking. His career trajectory sets him apart from other candidates, positioning him as a highly credible figure in this crucial role. Worsh served as a Federal Reserve governor from 2006 to 2011, a period that spanned the financial crisis. This experience gives him invaluable insight into the Fed's inner workings, and his tenure allows him to understand both the financial markets and government policy from an insider's perspective. Prior to this, Worsh worked in the White House as part of the National Economic Council, and before that, was part of the financial team at Morgan Stanley, focusing on mergers and acquisitions. This background is critical because Worsh brings three unique attributes to the table that matter in the role of Fed chair: an understanding of the Federal Reserve's operations, an awareness of Washington's political incentives, and a practical knowledge of financial markets. He's not just an academic theorist. He understands how markets react under stress, how liquidity can drive decisions, and how panic can trigger market movements. What makes his potential appointment even more significant is his connection to Stanley Druckenmiller, one of the most successful macro investors alive today. Druckenmiller, who has delivered exceptional returns over decades, has served as a mentor to Worsh. This relationship also ties Worsh to current Treasury Secretary Scott Bessent, who shares a similar investment philosophy rooted in liquidity, credibility, and balance sheet management. If Worsh takes the helm at the Fed, it could create a powerful alignment between the Federal Reserve and Treasury, with both entities operating under a shared vision for the future of U.S. monetary policy. Worsh's views on monetary policy: a shift in approach. Worsh's approach to monetary policy is distinctive and could represent a departure from the status quo. One of his central beliefs is that inflation is a direct result of central bank decisions. He famously stated, "Inflation is a choice," which translates into a clear message for policymakers. Stop blaming external factors like supply chains or geopolitical events for rising prices. In Worsh's view, the Fed's actions, especially those related to monetary expansion, are directly responsible for the inflationary pressures seen in recent years. Another key point in Worsh's philosophy is his emphasis on the Federal Reserve's balance sheet. This is a major shift in how most investors think about the central bank. While many focus on short-term interest rate changes, raising or cutting rates as a tool to control inflation, Worsh argues that a much larger lever is being ignored: the Fed's massive balance sheet, which includes trillions of dollars in government bonds and mortgage-backed securities. The Fed's approach to managing its balance sheet directly impacts liquidity in the financial system. When the Fed buys bonds, it injects money into the economy, increasing liquidity. Conversely, when the Fed allows bonds to mature or sells them off, it drains liquidity from the system. Worsh advocates for a reduction in the size of the Fed's balance sheet, which could lead to lower inflation without the need for further rate hikes. In simpler terms, Worsh is suggesting that by shrinking the balance sheet, the Fed could reduce the monetary fuel that drives inflation, thus allowing for lower short-term interest rates without igniting runaway inflation. This idea is not only significant from an economic perspective, but also politically relevant. It provides a framework where policymakers can talk about rate cuts without being seen as soft on inflation. But the real market impact will come from how investors perceive this shift in policy, the market's reaction, and what it means for assets. The market's reaction to Warsh's nomination has been swift, and the implications for various asset classes are significant. If Warsh is confirmed and his monetary policy framework takes shape, the most obvious consequence will be a tightening of liquidity in the financial system. With less money printing and less government bond purchasing, there could be fewer US dollars in circulation. This would lead to a stronger dollar, which is already beginning to show in the markets, as the recent fluctuations in the price of gold demonstrate. Gold, which tends to thrive in environments with abundant liquidity and a weaker dollar, has taken a sharp hit, dropping over 10% in the wake of Warsh's nomination. In addition, high-growth stocks, particularly those in the Nasdaq, have also seen a decline. These stocks, often referred to as long-duration assets, tend to perform poorly in tightening liquidity environments because their future cash flows are discounted more heavily when interest rates rise or liquidity shrinks. The bond market, however, could see an interesting dynamic. While the Fed may choose to lower short-term rates, there's a possibility that longer-term rates could remain high or even increase. If the Fed's bond buying slows or stops, the demand for treasuries could shift, driving up yields on longer-term bonds. This could create a steeper yield curve, with short-term rates staying low and long-term rates increasing. The market is already pricing in these expectations, which could have significant ramifications for stock valuations, particularly for high-valuation tech stocks. The likely scenario: a delicate balance between growth and stability. Looking ahead, the most likely scenario is a balancing act, where Warsh seeks to gradually shrink the Fed's balance sheet over time, while leaving room to cut short-term interest rates if necessary. This combination of policies could be seen as a compromise between the need for stability and the desire for growth. This policy mix would be difficult for many to reconcile because, traditionally, rate cuts are seen as a stimulus for economic growth, whereas reducing the Fed's balance sheet is viewed as a form of tightening. However, under Warsh's framework, rate cuts could occur without the same liquidity tailwinds that have driven the markets in recent years. This means that while rate cuts may make borrowing cheaper, the overall environment could be less favorable for speculative investments and more focused on long-term stability. Warsh's approach represents a new economic framework, one where balance sheets and credibility play a more significant role in shaping economic outcomes. This could be a positive shift for long-term stability, but it may be painful for industries and assets that have thrived on easy money policies. Stocks in high-growth, high-valuation sectors could come under pressure as a result of higher discount rates and tightening liquidity. What investors should watch? There are several key indicators to keep an eye on as the situation develops. First, the confirmation process for Kevin Worsh will be critical. Watch how the Senate reacts to his nomination and any political maneuvers that may impact his appointment. Second, pay attention to any public statements from Warsh himself. If he emphasizes the importance of shrinking the balance sheet and strengthening the Fed's credibility, it will be a clear signal to markets that liquidity could continue to tighten. Additionally, watch the yield curve closely. If long-term rates remain sticky or even rise despite the potential for rate cuts, this will signal that the market is focusing on bond supply and term premiums rather than short-term monetary policy adjustments. Finally, keep an eye on gold prices. If gold continues to struggle and fails to rebound, it will signal that the market is adjusting to a new economic regime, one where liquidity is tighter and the dollar is stronger. What works in this environment? While tighter liquidity may create challenges for many industries, some businesses are likely to thrive in this new environment. Companies with strong balance sheets, ample cash flow, and limited reliance on debt or external financing will be best positioned to weather these changes. Think of businesses like well-run insurance companies, such as Berkshire Hathaway, which can take advantage of higher interest rates by reinvesting their float in higher-yielding assets like treasuries. In a world of tighter liquidity and higher rates, smart capital allocation will be critical. Companies that can reinvest internally, buy back stock at lower valuations, or make strategic acquisitions during times of volatility will be the winners. For investors, focusing on businesses that are not dependent on cheap, plentiful money will be key to navigating this environment successfully. Final thoughts. The nomination of Kevin Worsh to lead the Federal Reserve represents a potential shift in the U.S. economic policy landscape. While this transition is still in its early stages, it's essential to understand the potential implications for liquidity, asset prices, and long-term growth. As always, the most successful investors will be those who understand the underlying dynamics and can adjust their strategies accordingly. This analysis is for informational and educational purposes only. It does not constitute financial advice, investment recommendations, or an offer to buy or sell any securities. Economic forecasts are subject to significant uncertainty. Viewers should conduct their own research and consult qualified financial advisors before making investment decisions.